What if your first $20,000 could become the foundation of your financial future, but you invested in the wrong place? A lot of Americans think investing means finding the next hot stock. That mindset can be expensive. The reality, you don't need to predict the next winner. You need a strategy built to survive the losers. Welcome to American Dream Finance. Today, I'll show you what I'd look for in a first investment in the USA in 2026, the mistakes that can destroy your returns, and the simple framework I'd use instead. Stay until the end, because the most important decision isn't which investment you choose, it's how you build a plan you can actually stick with. The biggest beginner mistake. If you're sitting on your first $10,000, $20,000, or even $50,000 and wondering what to invest in, there's one mistake I'd really want you to avoid. Don't start by asking, which stock is going to make me rich? That sounds like the obvious question. You have money, you want it to grow. So you open your brokerage account, look at the stocks that have gone up the most recently, and start searching for the next Nvidia, Tesla, or whatever company is getting the most attention right now. That's where things can go wrong. Because when you buy one company, your investment becomes heavily dependent on that one business. If the company performs well, great. But if something changes, its profits fall, competitors catch up, management makes bad decisions, or the industry changes, you can lose a significant amount of money, even if the broader economy is doing fine. And this is one of the biggest problems with looking at the past to decide what will happen next. A company can dominate an industry for years and still lose that position. Think about the technology companies that looked unstoppable 20 years ago. The list of market leaders changes over time. The companies leading the market today won't necessarily be the companies leading it 20 years from now. Past performance is not a crystal ball. That's why I don't think your first investment decision should be about finding the next superstar stock. It should be about building a portfolio that doesn't depend on one company getting everything right. This is where diversification becomes incredibly important. Instead of putting your entire $20,000 into one company, imagine owning small pieces of hundreds or even thousands of companies through one broad market fund. If one company has a terrible year, it doesn't automatically destroy your entire portfolio. That's one of the main advantages of broad index funds and ETFs. An ETF can pool money from many investors and hold a collection of stocks or other investments. Some broad funds can give you exposure to a large number of companies with a single purchase. And there is another important reason this matters. You don't need to predict which company will win. You're essentially saying, I don't know which individual company will become the next giant, but I believe American businesses and the broader economy can continue creating value over the long term, and I want broad exposure to that growth. That is a very different investing mindset, and it is much more realistic for someone who doesn't spend their entire day analyzing company financial statements. Now, there's an important correction I want to make to a common claim about index funds. You may hear someone say, just put your money in an index fund and forget about it. It's the easiest way to make a lot of money. I wouldn't phrase it that way. Index funds are not a shortcut to guaranteed wealth. They can lose money. A broad stock market fund can fall sharply during a market crash. There can be years when your account is worth less than what you originally invested. And there is absolutely no guarantee that your investment will double, let alone 10x. The reason I like the concept for a beginner isn't because it's guaranteed to make you rich. It's because diversification, low costs, and a long-term approach can remove some of the unnecessary decisions that cause investors to hurt themselves. And costs matter more than many beginners realize. Two funds can hold similar investments, but the one charging higher fees has to overcome those additional costs before you receive the same net return. The SEC specifically warns that fees and expenses reduce investment returns, and that even seemingly small differences can become meaningful over long periods. So if your first $20,000 is sitting in a bank account and you're thinking about investing it, I wouldn't start by asking, what's the hottest stock right now? I'd start with a much better question. How can I own a diversified group of investments at a reasonable cost without taking more risk than I can handle? That question changes everything, because the goal isn't to predict the future perfectly. The goal is to build a portfolio that can survive an imperfect future. And once you understand that, choosing what to buy becomes much simpler. So, if you're starting with your first $20,000, what should you actually do? The answer isn't to find the perfect stock. Your first job is to build a simple, diversified portfolio you can actually stick with. For many beginners in the US, that means looking at broad, low-cost index funds, or ETFs. An index fund is designed to follow a particular market index instead of trying to constantly pick individual winners. For example, an S&P 500 index fund gives you exposure to around 500 of the largest publicly traded U.S. companies. A total U.S. stock market fund goes even broader, giving you exposure to thousands of U.S. companies, including large, mid-sized, and smaller businesses. Neither option is automatically better. The important thing is understanding what you actually own. And here's something I want you to remember. Don't choose a fund simply because its name sounds impressive. Before putting your money into one, look at three things. 1. What does it actually hold? Open the fund's official page and check what you're buying. Look at the number of holdings. Look at how concentrated the fund is. Look at whether you're getting exposure to the entire U.S. market, large companies, international companies, bonds, or something much narrower. If you don't understand what the fund owns, don't buy it yet. You don't need to become a Wall Street analyst, but you should know what your money is invested in. 2. Look at the expense ratio. This is one of the easiest things to overlook. An expense ratio is an annual operating expense charged by a fund expressed as a percentage of your investment. It isn't usually a bill that arrives in your mailbox. Instead, it is reflected in the fund's expenses and therefore reduces your return. So, if two funds give you very similar exposure, but one costs substantially more, there's a good reason to ask why you're paying extra. Lower cost doesn't automatically mean better, but when two funds are doing essentially the same job, keeping unnecessary costs low can make sense over a long investing period. 3. Match the investment to your time horizon. This is where a lot of online investing advice becomes too simplistic. You might hear, stocks always go up over time. That's not how it works. Stocks can fall 20%, 30%, or even more during major market downturns. So before investing a large amount, ask yourself, when will I actually need this money? If you're investing money for retirement that you won't need for decades, you may have a much longer time horizon. But if that $20,000 is your emergency fund, next year's house down payment, or money you absolutely need in the near future, putting all of it into stocks could expose you to more risk than you can afford. That's why your timeline matters just as much as your return expectations. And there's another mistake I don't want you to make. Don't look at a projected 8% return and assume you'll earn exactly 8% every year. You won't. One year could be strongly positive, another year could be negative. The market doesn't pay you a fixed salary. Returns are uncertain. The reason long-term investing can work is that you're giving your investments time to experience different market environments rather than expecting a predictable result every single year. Now let's say you've already built your emergency savings, you don't have expensive credit card debt hanging over you, and this money is genuinely for long-term investing. You could then start comparing broad funds. For example, you might compare an S&P 500 index fund with a total U.S. stock market index fund. The S&P 500 focuses on large U.S. companies. A total market fund goes broader. There is overlap between them because the biggest companies make up a large portion of the U.S. market. So don't get trapped thinking you need 10 different funds just because 10 different funds are available. More funds doesn't automatically mean more diversification. Sometimes it just means you own the same companies through several different funds. And if you're investing through a U.S. workplace retirement plan, such as a 401k, start by checking what investment choices your plan actually offers. You may have access to low-cost index funds directly inside the plan. If your employer provides a matching contribution, understand the rules and make sure you aren't accidentally leaving available matching money on the table. For money outside your workplace plan, you might use an IRA or a taxable brokerage account depending on your circumstances, eligibility, tax situation, and goals. The account and the investment are two different decisions. Think of the account as the container and the investment as what's inside it. That distinction is incredibly important. And finally, don't let the word diversification make you think you need a complicated portfolio. You don't. A beginner's portfolio doesn't need to look like a hedge fund. It needs to be understandable. It needs to fit your risk tolerance. And most importantly, you need to be able to stay invested when the market gets uncomfortable. Because the best investment strategy isn't the one that looks amazing on paper. It's the one you can follow for years without panicking every time the market drops.
Now, let's make this practical. If you have money ready to invest and you've already separated your emergency savings and dealt with expensive debt, don't spend the next 6 months trying to become a professional stock picker. Start with a simple plan you understand. Step 1. Decide what this money is for. Before you open your brokerage account, write down one sentence. I'm investing this money for blank. Maybe it's retirement. Maybe it's financial independence. Maybe it's a long-term wealth-building goal. Your answer matters because money you need soon should generally be treated very differently from money you can leave invested for decades. Step 2. Choose the right account. If you're investing for retirement, look at the tax-advantaged accounts available to you. That could mean a 401k through your employer or an IRA, depending on your circumstances. If you're investing for a goal that doesn't fit a retirement account, a taxable brokerage account may be appropriate. Don't confuse the account with the investment. The account is the container. The fund is what you put inside it. Step 3. Compare broad, low-cost funds. Now look at the investment choices available to you. Start simple. Ask, what index does this fund follow? How diversified is it? What does it actually own? What is the expense ratio? Does it fit my time horizon and risk tolerance? You don't need to find the fund with the highest return from last year. You are looking for a fund that fits your plan, not a fund that won last year's race. Step 4. Make your investing automatic. This is where investing becomes much easier. Instead of relying on motivation every month, automate your contributions when possible. For example, you might decide that every payday a fixed amount goes towards your long-term investments. You don't have to constantly ask yourself whether today is the perfect day to invest. You're building a habit.
And if you have a large amount ready to invest, don't assume there is one universally correct answer about investing it all immediately versus spreading purchases over time. That decision depends on your circumstances, risk tolerance, and ability to stay invested. The important thing is to avoid turning uncertainty into permanent procrastination. Step 5. Prepare for the market to fall. This might be the most important step of all. Before you invest, imagine opening your account one morning and seeing that your $20,000 has temporarily become $15,000. Would you panic? Would you sell everything? If the answer is yes, you may be taking more investment risk than you can emotionally handle. A good portfolio is one you can hold through bad markets. Market declines are not automatically a sign that your investment strategy has failed. They're part of investing in assets whose prices move up and down. So make your plan while you're calm. Don't wait until the market is crashing to decide what you're going to do. And remember what we're actually trying to accomplish here. We're not trying to turn $20,000 into $200,000 overnight. There is no legitimate investment that can promise you a 10x return. The thumbnail may say, now your money could 10x future, but the word that matters is could. It is a possibility, not a promise. A diversified investment can grow significantly over a long period, but it can also lose value. Your actual result will depend on market returns, how much you contribute, fees, taxes, your time horizon, and your behavior. That's why I want you to think differently about your first investment. Your first investment isn't about proving that you're smart. It's about creating a system. Own diversified assets. Keep costs reasonable. Invest consistently. Give your money time. And don't let fear or excitement make your decisions for you. If you do that, your first $20,000 becomes more than just $20,000. It becomes the beginning of a long-term investing habit. And that's the real lesson. You don't need to predict the next big winner. You need a strategy you can stick with long enough to let compounding do its job.